Welcome, this is a new video that examines the causes and the policy responses to the Great Depression of the 1930s and the global financial crisis of 2008. So in this video, which is really about economic history, we'll examine the different interpretations of these historic events and how they might be explained according to a Keynesian and an Austrian perspective. A recession is defined as being a period where GDP falls for 2 consecutive quarters. So what's a depression? Well, most economists believe that a depression is a situation where GDP's declined by a significant amount. So during the Great Depression, the US lost a quarter of its output. So first off then is the magnitude of the fall in output. With the depression, it's a big fall in output. And then the second element of a depression is that the loss of output occurs over a long period of time. So in the case of the Great Depression, output fell for 10 years. The chart shows US GDP from 1910 to 1960. The Great Depression is marked in the purple shaded area, and you can see there just how deep this loss of economic output was and how long it took for the US economy to recover. So once again, depressions are prolonged periods where there are sizable losses of output. When output falls, firms don't need to employ as many people. So depressions are also associated with very high levels of unemployment. The Great Depression didn't just affect America, it also affected other countries like Britain. So these are unemployed workers from the north of England marching down to Parliament in London to complain about the economic depression that was affecting Britain in the 1930s. In Germany, Adolf Hitler used the depression to gain popularity and seize power. He advocated different policies that were designed to get Germans back to work, primarily by building autobahns and public works programs. So let's take an orthodox Keynesian interpretation of the Great Depression. We'll start by considering what Keynesians think caused the Great Depression. Keynesians believe that the level of output and employment is determined by the level of aggregate demand. When aggregate demand decreases, the aggregate demand curve shifts to the left. Firms will sell fewer goods and services. As a result of that, firms will want to cut production because there's no point in producing goods and services that aren't going to be sold. As firms cut production, the equilibrium level of GDP will begin to fall. In this case, it decreased from MY1 to MY2. Firms will also try to cut their prices in response to falling levels of spending, because they'll try to hold on to their market share. So what often happens is that you get deflation accompanying your loss of economic output. The Great Depression began in 1929 with the Wall Street crash. The collapse of US share prices shattered consumer confidence because most US households had bought shares. The negative wealth effect caused by falling share prices caused the consumption element of aggregate demand to fall. Firms responded to falling spending by cutting output in order to prevent the build-up of unsold stock. The decrease in aggregate demand caused the deflationary depression. Many households had borrowed money to buy shares. This is called buying on margin. So as I say, many households borrowed money from banks to buy shares during the 1920s, the roaring 20s. At the time, most people thought that share prices only ever went up. So from that perspective, it made sense to borrow to buy shares today because households expected to be able to make a profit in the future by reselling the shares that they bought at a higher price, making a capital gain. So this is an example of speculation. When the stock market unexpectedly crashed in 1929, households who had used borrowed money to speculate were in big trouble. They had no way of repaying the loans that they'd taken out to buy the shares that had suddenly crashed in price. Banks suffered losses on the back of these unrecoverable bad debts. Some banks were even forced to close down. Banks stopped making new loans to households and firms. This caused aggregate demand to drop further still, which deepened the recession that was now turning into a depression. Keynesians also assert that the depression of the 1930s was worse than it should have been due to demand-side macroeconomic policy errors. The first policy error that was made was protectionism. When the Wall Street crash occurred, there was this drop in consumer confidence. US President Herbert Hoover responded to the fall in aggregate demand and the initial fall in GDP by imposing tariffs. This led to a trade war and world trade contracted. For most countries, the X-M component of AD fell, which created further falls in output and employment. So the initial decrease in aggregate demand from AD1 to AD2 happened because of a fall in consumer confidence due to the Wall Street crash. That led to an initial drop in GDP from MY1 to MY2 and an initial burst of deflation from AP1 to AP2. So as I say, what happened was that this error was compounded by protectionism, which led to a second fall in aggregate demand from AD2 to AD3. The fall in aggregate demand caused another fall in GDP and some more deflation from AP2 to AP3. So Keynesians argue that it was a real mistake by the US government to respond to the Wall Street crash via protectionism, because what happened was there was a trade war, other countries retaliated, and everybody lost the X-M component of aggregate demand. The second policy error that was made was fiscal austerity. The initial rise in unemployment caused a cyclical fiscal deficit. The US government responded to the cyclical fiscal deficit by raising taxes and cutting government spending in a desperate attempt to balance the budget. Unfortunately, contractionary fiscal policy took aggregate demand out of the US economy, which caused aggregate demand to decrease again, causing further falls in both output and employment. So again, just tracing out the events here as they were happening. So we had the Wall Street crash, which caused an initial fall in aggregate demand. We then had protectionism, which caused another fall in aggregate demand, some more loss of output. And then on top of that, we had fiscal austerity, which caused yet another fall in GDP. So you can see how a recession morphed into a deep and prolonged depression. According to Keynesians, the third policy error was the gold standard. At the time of the Wall Street crash in 1929, US citizens could still exchange paper dollars for physical gold. So what that meant was that the dollar was fully convertible into gold at a pre-agreed rate, and citizens that wanted to convert paper dollars into gold could do. Following the stock market crash, US citizens rushed to exchange paper dollars for gold. As a result, the Federal Reserve's gold reserves were rapidly running down. Obviously, the Fed wasn't particularly keen on that. So, to encourage US households to hold on to their paper dollars, the Fed increased interest rates. Unfortunately, this tightening of monetary policy caused yet another fall in aggregate demand. So again, to recap, the first error was, well, the Wall Street crash, speculative bubble burst in the share market. We then had misguided austerity, and we've now got the gold standard. So with one policy error after another, we had bigger and bigger losses of output and falling prices. We had a deflationary depression. The final error made by the government was a refusal to use taxpayers' money to bail out insolvent private banks who had foolishly made loans to stock market speculators. Savers lost everything when the banks were allowed to fail because at the time the US government didn't operate a bank deposit insurance scheme. Consumption dropped again, which caused yet another fall in aggregate demand and therefore output and employment. So again, recapping, we had the Wall Street crash, we then had misguided austerity, we then had the gold standard error, and then finally a refusal to bail out the banks who lost money when the people that had borrowed from them to speculate on the stock market lost everything in the Wall Street crash. So you can see how the US economy ended up shrinking quite dramatically because of a whole series of errors, and the thing that these errors had in common was that they all decreased the level of aggregate demand in the US economy. So on the other side of the Atlantic, John Maynard Keynes was observing events. Keynesians, as you know, believe that the level of output and employment is determined by the level of aggregate demand. So what was Keynes's solution to the Great Depression? The answer was reflationary demand-side policies to pump up the aggregate demand in the economy, in the system, pump extra spending into the economy. So we might be in the teeth of the Great Depression, only producing NY1. So maybe we need some fiscal stimulus. Then maybe we need some interest rate cuts. Maybe then we need some more fiscal stimulus. And then maybe we need even more looser monetary policy. And this was a kind of Keynesian approach, like we need to keep on pumping aggregate demand into the economy via reflationary demand side policies until we get to full employment, GDP. The trade-off of that, the final margin might be a little bit of demand pull inflation, but a Keynesian would say that that's a price well worth paying to achieve the goal of full employment. So essentially then, Keynesians recommended reflationary demand side policies. So the US government broke the link between gold and dollars. They left the gold standard. That enabled the Fed to cut interest rates without losing all of the gold piled up at Fort Knox. The Fed also cut interest rates. They also increased the money supply. And the US government also ran huge fiscal deficits. Much of the money borrowed by the US government was used to build infrastructure projects as part of Franklin Roosevelt's New Deal. World War II also gave US politicians the cover needed to run even bigger fiscal deficits. It was all needed, you see, to fight the Nazis. Most of the extra money needed to finance those massive fiscal deficits was raised by selling bonds to the US people. So that's the Keynesian side of things. The Austrian school would disagree with much of what I've just said. They have a completely different explanation of what caused the Great Depression. So we're going to look at that now. Austrians believe that booms are credit expansions. Booms eventually turn to bust when borrowers default on the loans that they borrowed and spent during the boom period. When that happens, you have what's called a credit contraction. So the boom is the credit expansion, the bust is the credit contraction that follows the boom. So it's often said that the seeds of the bust were planted in the boom that preceded the bust. Or another way of saying it is, if you want to prevent a recession, what you need to do is to prevent the boom that preceded the recession. Recessions are credit contractions, so to avoid a credit contraction, you need to avoid the credit expansion that caused the credit contraction. So in the case of the depression of the 1930s, the credit expansion that preceded the Great Depression was called the Roaring Twenties. The Roaring Twenties was a decade-long period of credit expansion. It was a boom created by Americans borrowing and spending money. This decade of excess was all made possible by debt. Debt enabled households to transfer consumption from the future into the present. So during the 1920s, American households didn't just spend the income that they'd earned in the 1920s, they also spent much of the income that they were going to earn in the 1930s. Because that's what debt does. It allows you to spend some of tomorrow's income today. So as the 1920s progressed, American households kept on borrowing to finance consumption. When you borrow money to drink champagne, as time goes on, the amount of money that you owe increases. The total stock of debt owed by US households increased steadily. The more debt you owe, the more interest that you have to pay on those debts. Now the problem is, when you borrow money to buy consumer goods, it doesn't increase the borrower's income. So this creates an important dynamic. The borrower's debt to income ratio will gradually start rising. Similarly, the total amount of spending on interest as a percentage of the borrower's income will keep on rising. And eventually there'll become a point where you hit a debt saturation point where the borrower just can't take on any more debt because they're already struggling to pay the interest on the debts that they owe from the incomes that they're currently earning. So one more time here, if you borrow to finance consumption, that isn't sustainable because it increases debt without increasing the borrower's income. So eventually the borrowers will default on their debts. They won't be able to pay the interest or the principal owed because the debts will just overwhelm them. This is when the credit contraction phase of the Austrian business cycle begins. So households have begun to default on their loans, banks have been suffering losses, they start to make loans more carefully, credit starts drying up, households start to rethink their attitudes towards borrowing and saving and become more conservative. So what happens during the credit contraction phase is this phenomenon known as deleveraging. Deleveraging is just a fancy word that means paying down your debts. So during the credit contraction, when there's deleveraging, households save, which reduces consumption, which obviously reduces the amount of economic activity taking place. The bigger the boom, the bigger the bust. So why was the Great Depression so long and so severe? Well, it was a 10-year bust that had been created by a fairly amazing 10-year boom that preceded it. The more debt that was taken on during the boom period, the longer the period of deleveraging will be to pay it off. During the credit contraction, when demand starts decreasing, businesses that have borrowed money to expand, many of them will realize that their investments didn't really make a lot of sense. Those investments that were maybe speculative too, that didn't really add to the productive capacity of the economy, Austrians will call those malinvestments. So during the credit contraction, during the bust period, those malinvestments will need to be purged and the economy will need to be rebalanced. The economy will need to be rearranged. Factors of production will need to be moved from one industry to another. So as Mises says here, the boom squanders through malinvestment scarce factors of production and reduces the stock available through overconsumption. Its alleged blessings are paid for by impoverishment. So what Mises is basically saying here is that during the boom, borrowed money was used unwisely to set up all sorts of harebrained business ventures that only made sense when people were borrowing and spending money like it was going out of fashion. As soon as a credit contraction begins, all of that excess spending is no longer there. Households instead are cutting back. So these businesses that might have done well during the boom, the demand just falls off a cliff, and so you've got a lot of businesses that are no longer viable. Those businesses should be forced out of business. The factors of production used by those businesses are then released back into the economy so that they can then be redeployed by other businesses that are expanding and growing, who are able to cope with the new reality and are able to provide consumers with the things that they want in an era where households are spending money more wisely. So again, the longer the boom, typically the longer the bust will be. So if we've had a decade-long boom, there will have been a lot of malinvestments that will need to be purged. A lot of crazy businesses doing quite odd things, decadence. All of those resources will need to be reallocated, and that might take some time. Austrian economists are less convinced about the economic benefits of war. They argue that war destroys factors of production, most obviously labour, but also capital too. And during World War II, life wasn't particularly great, even for the people that managed to survive. Life was grim. There was food rationing, clothes rationing. Things weren't good. To claim that World War II saved the economy is a terrible thing to say, given that World War II created such enormous misery. The other thing to bear in mind too is that war just didn't create misery for the generation that actually fought the wars. Governments took on huge amounts of debt to finance war, and those debts compromised the living standards of future generations. So as this article here from 2015 illustrates, Britons were still paying taxes as late as 2015 to pay the interest on debts that were ran up to fight World War I. So in economics, there's no such thing as a free lunch. Both world wars ran up huge amounts of debt and led to fairly dismal standards of living, particularly in the 1950s and the first part of the 1960s. So let's turn our attention to the global financial crisis of 2007-2008. We'll start off by examining the Keynesian consensus. So according to Keynesians, what caused the global financial crisis? Keynesians argue it was all the government's fault. Governments deregulated the banking industry, and that allowed banks to make loans to so-called subprime borrowers, people with poor credit ratings, and that ended in disaster when those subprime borrowers defaulted. They couldn't pay back what they borrowed. A borrower defaults when they're unable to pay the interest or the principal on what they've borrowed. So in this case, much of the money was lent out into the housing market. So when borrowers defaulted on their mortgages, the banks who had lent the money stopped receiving interest. So what happened then was that the banks repossessed the houses, put them up for sale. But unfortunately, when the houses were sold, they were sold for far less than the original mortgage, creating losses for the banks. The losses caused by bad debts, caused by the defaults, then created a credit crunch. Banks began to reassess risk and they became more prudent. They became less willing to advance new lines of credit to households and to firms. And this created a phenomenon called the credit crunch, which is a phrase that just describes a situation where it was harder for households and firms to borrow money. So there was a sharp reduction in the availability of credit in the economy. Keynesians would argue that the banks overreacted. Keynesians believe in this idea of animal spirits, that expectations of the future can create economic realities. So if banks and businesses predict hard times ahead, their behavior will adjust, they'll become more cautious, they won't lend as much, they won't spend as much, and the recession that they predicted will come true through the actions that they took on the basis of their gloomy hypotheses about the future. So again then, we had the economy doing fairly well prior to the 2008 financial crisis. We then had the credit crunch, which basically decreased aggregate demand, not as much borrowed money available, consumption fell, firms couldn't get their hands on loans either, so investment fell. So the decrease in aggregate demand meant that there was less being spent, firms sold less goods and services. So as a result of that, firms cut production to prevent the buildup of unsold stock, and that caused a fairly nasty fall in GDP, which was accompanied by some deflation too. So what was the Keynesian policy response to the global financial crisis? Well, as you can imagine, Keynesians believe that the level of aggregate demand determines the level of output and employment. So they went for reflationary demand side policies, the same sort of thing that Keynes had recommended back in the 1930s. So central banks cut interest rates to practically zero. Central banks also used quantitative easing to increase the money supply. And governments also ran fiscal stimulus by increasing government spending and cutting taxes to inject aggregate demand into the economy through fiscal policy. So the $1 million, or should it be the $1 trillion question is, well, has it worked? Has Keynesianism worked this time? Has the policy remedy of injecting aggregate demand through monetary and fiscal policy, has it actually worked? Well, quantitative easing has certainly stopped the housing market from crashing. Asset prices have risen. That's great news if you own assets. On the other hand, if you're a young person just starting out, high house prices for you are not a great thing, because when you want to buy, you have to take out a much bigger mortgage. So you could say that the boom created by the loose monetary policies adopted by central banks have created asset bubbles, and they've also created intergenerational wealth divides. So those that own property prior to interest rates being cut have generally benefited, whereas the young have been left behind. They've been priced out by the house price inflation created by the super loose monetary policies operated by central banks since 2008. According to official data, the UK's got near record levels of employment. So again, a Keynesian would claim that reflationary demand-side policy worked a treat. However, that said, even before the dreaded coronavirus, you could argue that we need to look at the type of jobs that have been created in recent times. So many of the jobs created have been insecure, low-paid jobs in the service sector, part of this so-called gig economy. So it's been very difficult for young people to get ahead because they're often working in low-paid, insecure jobs. And it's very difficult for them to accumulate wealth, even through saving, because interest rates are just so low. So their savings compound at a very, very, very low rate. Actually, once you take inflation into account, it's impossible to accumulate wealth because we're actually looking at negative real interest rates. So if you save money at the end of the year, your wealth has declined. Certain groups in the economy too haven't received a proper pay rise for years, so that's often public sector workers. So in real terms, their pay is lower now than it was in 2008 because their nominal pay rises have lagged behind the rate of inflation. Also, for many working class people, their wages have been compressed by immigration. Immigration again has been fairly good for growth. You're importing extra labour. That will increase the natural rate of employment. From an employer's perspective, cheap labour means lower wages, lower costs. For the likes of Tesco and house builders, immigration means more customers, more revenue, more profit. But as I say, for working class people that work in shops or building sites, their wages have been compressed by immigration. So again, after inflation, their real wages in 2020 are a long way below what they were earning 20 years ago. So although Keynesians might claim that their reflationary demand-side policies worked after the 2008 financial crisis, this sort of so-called recovery has lacked a feel-good factor. Most people can't actually see where economists get this idea from that the economy's recovered because their living standards haven't. They've actually declined. The other problem is that the UK economy remains horrendously unbalanced. Our service sector is way too big compared to manufacturing. So when the Keynesians injected aggregate demand into the UK economy, British households spent the money that was injected into the economy, but they were primarily purchasing imports with it. So the recovery has created a big current account deficit, and it's also created, as I say, low paid jobs in retail, selling the imports that are being bought with the borrowed money that the central banks have been injecting into the economy. Deindustrialisation has also reduced the power of the UK government's fiscal multiplier by increasing the marginal propensity to import. So if you think about, well, many manufactured goods, like take TV sets, training shoes, sofas, British people still want to buy manufactured goods. The problem is most of those manufactured goods are now imported. So when the government borrows money and injects it into the economy through fiscal policy, all that tends to do is suck in imports. And that creates a very disappointing fiscal multiplier effect, a very low M value. The countries that have benefited have obviously been the countries where they've been manufacturing the goods that have been sold in British shops. So you could argue that UK fiscal stimulus has just helped the Chinese economy to grow. So that's the Keynesian side of things. Let's turn our attention now and look at things from an Austrian perspective. How would they explain the global financial crisis? Again, what an Austrian would say is that the seeds of the bust were planted in the boom. What the global financial crisis was the beginnings of a credit contraction, and the credit contraction was caused by a credit expansion that preceded it. Most booms, most credit expansions are initiated by central banks who make the error of setting interest rates too low and keeping them there for far too long. So you could trace the global financial crisis of 2008 back to September the 11th, 2001. Following 9/11, the US central bank cut interest rates to practically zero, and most other central banks around the world followed. Indeed, on 9/11, George Bush went on TV and actually urged US shoppers to go out and buy stuff with borrowed money to save the US economy. And they followed his instruction to the letter. Commercial banks were also very willing to extend lines of credit to all and sundry. Many people believe that even then the commercial banks realised that they were too big to fail, that if they were ever to make mistakes and make loans to people that would fail to pay them back, it didn't really matter because the government wouldn't allow the banks to fail because of the economic consequences, and they would get bailed out using taxpayers' money. So this created a moral hazard. Banks were incentivized by the moral hazard to make all sorts of loans to all sorts of people. You could get whatever mortgage you wanted so long as you could fog a mirror, and this also contributed to the credit expansion. So throughout the credit expansion party, households were borrowing and spending. But the problem here again is that when you use credit to finance consumption, debt builds up without a corresponding increase in the borrower's income. By 2008, a lot of households were struggling with the debts that they had, and their incomes hadn't gone anywhere, and so they were struggling trying to find the money to pay the interest on the debts that they had. And at this point, households began to default. So basically phoning up the bank saying, can't pay, won't pay. Some households would declare themselves bankrupt. Commercial banks are obliged, just as any other businesses, to write off bad debts, unrecoverable debts, as a one-off loss to their profit and loss account. As a result of the defaults, banks made absolutely monumental losses. Some banks didn't make it. The most famous example was Lehman Brothers, and in Britain, Northern Rock. So again, banks started to reassess risk when the losses started to pile up. Households themselves became a little bit more cautious about borrowing and spending. So we have a credit contraction. The boom's over. We're now in a period of deleveraging. Well, that's what should have happened. Households should have begun to deleverage, which would have involved them reducing their consumption to pay down their debts. Unfortunately, from an Austrian perspective, politicians weren't prepared to allow a period of deleveraging because that would have led to a fall in economic activity, and most of these guys would have lost their jobs. Malinvestments should have been purged and resources reallocated, but this didn't happen. During a credit contraction, the economy would have rebalanced away from services back towards manufacturing. But again, this didn't happen because the politicians didn't allow the credit contraction phase of the Austrian business cycle to take place. So politicians the world over fought as hard as they could to avoid the credit contraction because they didn't want the political consequences of recession. So the solution was to pursue a new second credit expansion built upon the previous credit expansion, to build a credit bubble on top of another credit bubble. So how did they do this? Well, obviously central banks have been using quantitative easing to print money. At the time I'm making this video, Donald Trump has instructed the Fed to print money and issue it directly to US households. This is the idea of helicopter money. Anything in a desperate attempt to boost aggregate demand. Remember, Keynesians have this fixation with aggregate demand. The solution to any problem is more aggregate demand, injecting more credit into the system. And this is what policymakers have done. Rather than allowing banks to fail like they did in the 1930s, the banks that had made the bad decisions, that had lent way more than they should have done to people that shouldn't have been given credit, well, what happened to them? Did they pay the price of their mistakes? No, they were bailed out. The logic being that we need solvent commercial banks so that we can keep the supply of new lines of credit going to keep aggregate demand increasing. So banks were bailed out, a big difference from the 1930s. Interest rates have been cut again. They went up slightly after 2012, something like that. They're now back down at zero. Again, what's happening is financial repression against savers. Keynesians believe in the paradox of thrift. This is the idea that saving might be beneficial for individuals, but because saving reduces consumption, it's deemed to be economically undesirable at a macro level as far as the Keynesians are concerned. So central banks are keeping interest rates as close to zero as possible to try and punish savers to get them to consume instead. Also, cheap money encourages households to keep on borrowing and spending. To an extent, households have risen to the challenge. Yeah, they've taken advantage of cheap credit and they've carried on consuming. Another round of borrowing and spending began as a result of the policy responses to the 2008 global financial crisis. But again, the inescapable problem is that if you keep on borrowing and consuming using debt, then your debt levels increase, but your income doesn't, and it just becomes a matter of time. Lowering the rate of interest gave households some headspace. When you lower interest rates, the monthly repayments on a fixed stock of debt fall, and that gives households some extra disposable income which they can then go out and spend. And as I say, a lot of UK households did exactly that. They had mega debts in 2008 that they couldn't service at 6% interest. So commercial banks helped them out, central banks helped them out, cut interest rates. That allowed households to embark on one last round of borrowing and spending. The problem is that debt levels now, both public and private, are higher than what they were in 2008. And we're heading towards a debt saturation with interest rates at close to zero. Interest rates can't be cut below zero. So when households begin to default at 0% interest rates, policymakers have kicked the can about as far down the road as possible. So one thing that will happen when households begin to default is that policymakers won't be able to save the economy in the same way that they did in 2008 by cutting interest rates, because interest rates are already about as low as they can go. So you could argue that policymakers have run out of road to kick the can down. So how have policymakers responded to COVID-19? Well, here in Britain, What's happened is that there's just been more of the same, massive fiscal deficits financed by the printing press. So the Bank of England is now creating new money through quantitative easing, and they're buying government bonds directly from the Treasury. So essentially, the Bank of England is printing money to finance furlough payments of 80% of wages to 25% of the workforce. So we've got a huge expansion of the supply of money. So most people would argue that eventually this will lead to inflation. If velocity of circulation is close to zero, the money printed will stay on the sidelines and it won't affect price levels. However, in this case, the Bank of England is printing money, and this money is going straight into the pockets of ordinary people who are receiving furlough money. That money is being spent on everyday items like food, etc., clothes. At the same time, a quarter of people not working means a sizable reduction in output. So if you add those things up together, an increase in the money supply, the velocity of circulation becoming positive, and a fall in output, there's obviously implications there for inflation. So this quote from Mises seems appropriate at the current time, and it's often referred to as the final collapse. So according to Mises, there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. So to translate this, what Mises is basically saying is that there was a possibility to save fiat currencies such as the pound and the dollar back in 2008, but that would have required us to undergo a fairly painful period of credit contraction. But policymakers weren't prepared to accept that. What they did was try to build a new credit expansion on top of an existing one. We're now into the policy response to COVID, so you could argue maybe there's a third credit expansion currently being engineered. And essentially what Mises is saying is that if you keep on printing money like this and expanding credit, eventually people will start to lose confidence in the purchasing power of paper money. And when that happens, it will no longer become acceptable as a means of exchange, or certainly when people receive their paper money, they'll choose to spend it as soon as possible before it loses value. So that will cause the velocity of circulation of the money supply to pick up. So even if the government and the central bank stop issuing new money at this point, that still won't be enough to save the economy from hyperinflation, because an increase in velocity will increase total expenditure, which will force prices up. Higher prices will cause households to reassess their behaviour and spend their money even faster, so velocity increases again, which causes further increases in expenditure and further inflations. So there's a feedback loop between V and P in Fisher's equation of exchange. And that brings us to the end of this video.